about green in finance and financing green. What will it take to turn African markets into destinations for green finance? Before we start our session, I would like to provide a little bit of an introduction about FSD Africa. We are a development agency wholly funded by the UK's government's aid, and we have a mandate to strengthen financial markets across Africa. And one of our core themes of our work is green finance and climate finance. And we provide technical and financial assistance to debt capital markets and capital markets stakeholders to basically channel flows of capital into Africa in order to really build the type of economy, the type of infrastructure that we require as a society in order to meet the goals of the Paris Agreement. And so today's sessions will explore how global flows of green finance can be channeled into the continent. So as a bit of a background, you might all know that basically post-pandemic, global flows of green finance continue really their upward trajectory, and a record green bond issuance was recorded in 2020. And more than a third of total assets under management could be aligned with the ESGs by 2025. But despite this boom in green and sustainable finance, Africa still captures only around 3% of green investments around the world. And we really need to close a $500 billion gap in order to basically allow developing economies to meet the SDGs and provide greater access to capital markets to expand the green economy. And therefore, this event today really seeks to explore the skills, the data, the policies, and perhaps the standards that are required to underpin African rise as a green finance destination. And we really wanted to encourage a dialogue between African voices and global financial markets by bringing together policymakers and investors from the continent and to basically facilitate the dialogue amongst them. So together today, we will discuss the existing barriers to sustainable investments in Africa. We will share case studies of effective policies and explore the steps that can be taken perhaps in the near future in order to allow financial markets to thrive within the green economy. And so for this purpose, I would like to basically introduce and to welcome and really to thank three distinguished guests that we have today in our panel. Amak Ansofo, Executive Director of Debt Capital Markets with Standard Chartered Bank. Emmanuel Atederi, Senior Vice President at FMDQ. And finally, Dr. Gregory Jamobe, Executive Director at Access Bank PLC. And so to really begin our discussion, I would like to start with Amaka. And basically, I would like to ask you, according to your experience as a deal originator, Standard Chartered has really facilitated a lot of green deals in the continent. But what are the top three barriers or gap that often hinder more green debt issuance in Africa, according to basically your experience?
Thank you very much, Matteo, and good morning / good afternoon, everyone, depending on where you are. Definitely a pleasure to be a part of the panel. I think this is, very topical, given that if you look at the opportunities, Africa presents an immense opportunity for green financing, just given the level of development in the region. But again, as you mentioned, this is actually where we see it less relative to the other developed markets. And if I were to kind of look at the top three barriers, the first one that I would tackle is the perceived complexity of the process. I use the word perceived because it is not as complex as most borrowers, actually think it is. For a borrower who is looking to access green financing, right, part of the first things that they have to do is to even understand their assets. You know, what qualifies for green and what does not qualify for green. And a lot of borrowers struggle in that regard. And after the asset understanding, they then need to set up a project evaluation and selection committee or team that would actually select what eligible projects that they can fund using this route. Post that as well, they have to have a framework for managing the use of proceeds. And then we also have the ongoing reporting, which they have to do both on allocation and on an impact reporting basis. So when many issuers or many borrowers look at this, they already get turned off in the sense that this is actually a lot of work and we don't have the right infrastructure to do that. And unfortunately, globally, we actually don't have a lot of data availability that guides issuers and borrowers through this process. It's funny, I was speaking to a client of mine yesterday, and what she mentioned was that, look, they've been on it for a year in terms of sustainable journey in-house, in terms of trying to put together something that will enable them, you know, access green financing from the market. And this is something that we global banks do within 8 weeks, right? So there is that knowledge gap that is there. So what we're effectively doing as originators and the banks is really working with these issuers now to actually bring them up to speed. We help them to craft the framework. We help them to go through their asset portfolio to actually analyze it. We help them to, you know, set up teams that will do the project evaluation and selection. And we then help them to set up a framework that will help them for the ongoing monitoring and reporting based on what we have done, as well as what we have done for our clients as well globally. And we're seeing that starting to change the curve. So for most of the borrowers who shy in terms of cost, not just cost for the time involved, but also the financial resources. A lot of what we tell them is that, look, this is a journey that is worth embarking on. Because once you take this first step and pass the learning curve, you tend to find out that the advantage that you get in terms of ability to diversify your sources of funding, crowd in external capital, will ultimately favor you from a pricing perspective and set further milestones for you from a borrowing perspective. So, you know, that's one area that I would tackle. The second one I would say is overemphasis on green. And there is a reason why I say that. If you look at Africa, for instance, and even most emerging markets, one thing that is clear is that we don't have a lot of bankable projects. So if you look at projects themselves that lend themselves to green financing, it's, you know, clean transportation, renewable energy, infrastructure, you know, and these are areas where at the start, there is a lot of feasibility studies that go into that process before it then gets to the stage where private lenders are able to lend into an effectively de-risked project. And that is something that we don't yet have a lot of in the region. So at that initial stage of the project, it's not really a stage where you kind of attract capital markets investors like the, you know, pension funds or the asset managers who would rather come in when there is more sufficient track record. So we see a lot of DFIs and banks playing in that space, right? Now, for financial institutions who fund these projects, when you go to them to raise green financing, part of the things that part of their concerns is that they don't have sufficient green portfolio to lend on the back of that. A typical benchmark Eurobond transaction, for instance, is a minimum of $300 million. And these issuers need to make sure that they're actually reporting on an annual basis on the use of proceeds. So they worry that I don't want to go ahead and set up a framework, launch green financing, and then find out that I do not have sufficient proceeds or projects to lend this funding to. And that is where the overemphasis on green then comes in. So what we do tell these borrowers is this: set up what you call sustainable bond framework or sustainable financing framework that caters for both social and the green elements. Even if you start off with most of your portfolio being social, over time you scale up on the green side as well. And that is what we saw earlier in the year when we brought a client to the market. When they came to the market, 90% of their portfolio was social, because in Africa you have, you know, whether it's healthcare, whether it's you know, affordable housing, micro lending, women in business. There's a lot of social angle. So this entity actually had 90% of their projects in social and only 10% in green. But because they already had that broad sustainable framework, they made a commitment to investors that over time, their aim is to then use this framework to scale up the green elements of their portfolio. So that's another bit. The third one that I would then touch on basically is what I would call lack of embeddedness of green objectives in a company or a country's strategic priorities. And I'll tell you what I mean by that. So if you look at Standard Chartered, for instance, when you go to our website, the first thing you see is, driving sustainable financing through our unique diversity. It's a core objective of the bank and it filters down from the top. So if you look at a banker who is looking to originate transactions, that you actually get more credit if the transaction that you're creating is in a sustainable format. When you have that objective from the top, having a sustainable team or having a project evaluation and selection team doesn't become a time wasted, or it doesn't become an effort. It doesn't become a something that you have to do or something you want to do, or rather it's not a good to have, but a must have for the organization. And that's what we also see with countries. Many countries have signed up to the Paris Agreement, but you then find out that many of the African regions who have actually taken the step to issue green bonds are those that have in place, either they passed the climate change bill or it's embedded in their national policy. They've set up ministries to run this platform. And in that sense, you then find that there is commitment from the various debt management offices to drive these agendas through the issuance of sustainable funding. So I will just stop there, but I would highlight those as kind of like the three key areas.
But I mean, I think that what you said is very interesting about the DFIs, because basically when we look at green investment into Africa, we realize that there's just not enough of it, right? But also that the vast majority of it is also funded by DFIs. So do you see an increase in the growth of private investments into the green economy in Africa, whether from domestic or international investors? And as a consequence, what is the interaction between private investors and DFIs when driving sustainable finance, really?
Thanks, Matthew. I think definitely, by virtue of their mandate, the DFIs have been at the forefront of driving, green and sustainable financing in the Africa space. As I mentioned, particularly at that early stage where you need technical assistance for the projects to actually kick off. But what we then do later is to use private sector investments to refinance some of these borrowings to free up capacity for the DFIs to actually do more. And notably, over the past 24 months in the wake of the COVID pandemic, I can say very clearly, particularly on the international investor side, that the interest to invest in green and sustainable projects across Africa has increased significantly. Last week, we were on a roadshow with the Nigerian government to raise $4 billion in Eurobond. 75% of the investors in that roadshow posed the question to the minister, when are you issuing an international green bond? And that is not just akin to Nigeria, it's across many issuers that we have brought to market recently. We get a lot of reverse inquiries frequently telling us, look, I'm interested in this issuer in this sector. This is the amount I'm ready to go for. Long tenor, attractive pricing. Can they give me green funding? So there is definitely that increased drive. And what we're then doing as well in partnership with the DFIs, particularly in the public bond markets, is to use the DFI interest as an anchor to crowd in private sector investors. So earlier in the year, in June, we did a $350 million Eurobond for ETI, which is a Pan-African bank with presence in 33 countries across Africa. It was the first tier 2 instrument under Basel III outside of South Africa, and it was also a 10-year bond. So quite a risky profile from one that the investors were used to. But they had a sustainable objective as part of that funding, right? So we got FMO, who is the Dutch DFI, to anchor the transaction. And with the FMO involvement, investors were very comfortable in the fact that FMO was there. They had looked at this project from the start. They had reviewed the framework in detail and were comfortable with it. Therefore, it was kind of a stamp of approval. So we actually used that to galvanize other private sector investors into the trade. And for a $350 million transaction, we got an order book of about $1.3 billion, just interest in that trade, despite the risk that was inherent in the trade, because it was a sustainability bond backed by FMO. So that's also the interaction between the private sector and the public sector in these types of financing.
So de-risking, basically.
Exactly.
And really, I mean, your work at Standard is incredible in terms of setting a bar for the market in Africa and really supporting the establishment of green and sustainable markets in Africa. And really, your work, as you mentioned, is not just about green or finance, but also the establishment of wider social, green, and sustainable framework for bonds, isn't it? And do you think there are external regulatory pressures or influences coming from more advanced financial markets that at the moment you think would be a step too far for Africa at the moment, given that we are basically setting up the market?
I would say that, let me give an example. One of the biggest topics at the moment is the EU taxonomy, and which is basically a classification system that defines, technical screening criteria for certain projects, and basically having investors and companies and policymakers have a common language with regards to what is actually defined as environmentally sustainable, what are the criteria, and how do you define, identify these projects on a standardized basis. It is very positive in terms of the global ESG landscape, and it's a very, big landmark. But coming down to Africa, we tend to see that some of the standards are a lot more stringent than what we would see here. And we can't really apply them on a like-to-like basis. So I would use aluminium, for instance, right? There is a global industry body, Aluminium Stewardship Initiative, which actually specifies the thresholds, for instance, for carbon emissions and things like that. So you tend to find out that some mines in Africa would qualify under Aluminium Stewardship Initiative standards, but because their standards are less stringent than the EU taxonomy, it doesn't qualify under an EU perspective. And what we tend to see is that most European investors, there's a lot of pressure in making analysis on these investments to make sure that they're analyzing them based on the EU taxonomy. So again, we see that because we're coming from when it comes to level of development and access to technology, the Europe and Africa are very diverse, right? We're coming from a really high base in terms of carbon emissions and things like that, whereby the European economy are coming from a much more lower base, given that they have been working on this over a past number of years. So I'm not saying Africa has to cut corners. We have to do the right thing. We comply with the standards set by the Global Initiatives Board, the ICMA Green Loan Principles, LMA Green Loan Principles, but sometimes they may not be as stringent as some of the new regulations that are coming out. And that is where we kind of need investors to be a little bit, I would say more realistic, or not a cookie cut approach in looking at both markets.
Yeah, for sure. So different stages of development of the market, different regional perspectives, different economies, and different technologies being used, really. So no, it completely makes sense. And thank you, Amak. I think it was your experience as an originator has been incredible, and I think we can all thank you very much, not just for developing the market today, but really providing this perspective for us for the session today. It's been incredible. Emmanuel, I wanted to ask more on a policy perspective. FMDQ really represents the interface between the regulator and issues in the market in Nigeria. We've heard Amaka, and we've heard her experience on the origination side and experience with issuers, and we talked about real life gaps and real life hurdles that there can be for issuance of green debt and green bonds in Africa. So my question to you, and I think that this is something I think is really important for us to be able to understand the market. What can regulators do in order to build a robust ecosystem of green debt issues in Africa from a policymaker's perspective?
Thank you very much, Matthew, and good morning, good afternoon to listeners wherever you are across the globe. I think that's a very important question, and in order to answer that, I'd like to mention that my colleague on the panel, Amaka, has already touched on some of the key points that regulators need to do in order to build that robust ecosystem for green capital markets that we desire for Africa. And the first point is for regulators especially, for example, in Nigeria, to support the move to pass the climate change bill and make it a law in Nigeria, because the first thing you need to do in order to build a market is to set the guidelines, the rules, and the laws that enable the actors in the ecosystem to actively perform their role. Where there is no law, no rule, no established guideline, the market cannot be expected to develop effectively or to grow swiftly. So the first step is in supporting that move to pass the climate change law in Nigeria. Let me tell you what that law can do. It can help to mainstream climate change actions and establish what has been named or called the National Council for Climate Change. And when that happens, it will provide a budget, a carbon budget for Nigeria, and it will help to help us to achieve that push for net zero emissions between 2050 and 2070 or 2035 or 2050. It will also help us to attract investments from the international players that Amaka mentioned, because one of the key factors I discovered in trying to find out why Nigeria, I know you mentioned that we only receive 3% of flows into Africa, but of that 3%, Nigeria is, I dare say, receives the least amongst its peers in Africa. And when I interrogated several stakeholders from the international development finance space, one of the key factors they mentioned is the absence of an enabling law for climate change in Nigeria. And I think if that law is passed, it will do a lot of good for us. Also, some other salient points that the law could bring for us is that it will help us to develop policies for our biodiversity, what they call nature-based solutions, such as reducing emissions from deforestation and forest degradation. Nigeria has a very rich natural capital. Our biodiversity base, our resource base is very rich, and we need to tap into that resource more effectively. These are some of the things that will be contained in that law when it is passed. I've been privileged to interview one of the best minds in terms of climate change, Professor Chukwumerije, who is also a part of the IPCC. Is a Nigerian who has worked on this law. Is currently with the Senate. The House of Reps have passed the law. We're waiting for the Senate to pass it and then to go to the President for assent. We need to accelerate that move. The second part of my intervention will be that, the players in the financial market regulatory ecosystem, the central bank, the SEC, Securities and Exchange Commission, the Debt Management Office, all the key actors in the regulatory space need to, put more effort into ensuring that the recently developed guidelines on Nigeria sustainable finance principles should be, marketed to the stakeholders. The implementation should be enhanced, and I know they've released it, but it's just been released, and I don't think enough attention has been paid to it or to get that documents to be imbibed by the stakeholders in the market. So that's, I think we heard about the release of that principle in March. By now, there should have been sensitization sessions, webinars, meetings, engagements with the key actors, and ensuring that there's enforcement. Because one of the key points in that principle is that, regulated entities should regularly report on, the progress they are making in implementing the ESG principles in their organizations. They must report regularly on the steps they are taking to implement ESG, and they must also disclose this in their annual reports, in their communication with their investor base. These are the critical things you need to enlarge and enhance that ecosystem. Also, finally, on the issue of what regulators can do, I think there's need for us to look at how the central bank can consider what they call green central banking. And the Nigerian Central Bank can take steps and should take steps to join its peers globally in the network for greening the financial system, which is the club of central banks that are working towards including, climate risk into macroprudential oversight work. that they're doing for banks. Until you include those components, the banks, for example, apart from Amaka's bank, that is a global bank, and a couple others who are serious about sustainability, like my friend and brother from Access Bank, the other banks in Nigeria only pay lip service, to the best of my knowledge, to the Nigeria Sustainable Banking Principles, which they are signatories to. So I did an exercise with some banks in the sector, and we had a conversation with Access Bank before we started, because they already have their own process set out clearly. And I used to joke that they are a purple star a bank, if you like, in Nigeria, because they've issued the first corporate issue in Africa. But the other banks that we investigated, what we found out is that there's a sort of lack of knowledge, and there's also a lack of awareness. Where there's knowledge, there's a denial. There's an assumption that since we only contribute 4% to global GHG emissions, why should we bear the responsibility of mobilizing finance, of taking the steps to combat climate change? But the truth is that climate change is right at their doors. It's right at the doorsteps, and could impact on them from a stranded asset perspective and also from a physical risk perspective. So I'll just stop there for the moment and say that what I expect regulators to do will also be to, for example, SEC, they can, for example, support the creation of dedicated green investment funds so that we can encourage investments in this area too. These are some of the critical steps I think we can take from a regulatory perspective to support the building of that ecosystem for green in the capital markets.
And what do you think, Emmanuel? I think that because we're talking about what policymakers can do, what do you think that were physically the top 2 or top 3 most effective policies that have supported the market, especially for private sector in Nigeria or generally in Africa? What do you think the top 2, top 3 policies that can actually be most effective to stimulate the market?
Okay, so in response to your question, the first point I'd like to make is about a fast-track process for green issuances. This is a hard pill to swallow for most regulators, because especially from the developing markets, because the focus for markets like ours is on investor protection. So when you talk about a fast-track process for issuance, the regulators get worried because they want to be sure that every issuance passes the test of transparency, of market, having that confidence that the issuer has the capacity to issue, the background, and the ability to service his debt for the life of the bond. So the concern for most third world regulators is on investor protection. I say this because I had the privilege of interacting with the representative of the Moroccan capital market authority, and he shared his views with me on the risk of trying to create a fast track process for issuing green bonds. But we've seen that in Malaysia they have what they call the lodge and launch, or in short the LOLA. So that process means that an issuer can virtually issue his security in 24 hours. But the responsibility for ensuring that that product is kosher, and that it is sound, and that it will not fail is on the key parties to the issue, what they call the responsible parties. So I've tried to talk to the Nigerian SEC on LOLA. I spoke to the Moroccan capital market regulator on LOLA. The same views were expressed by the two regulators independently and at different set times. The fear of the fact that you could inadvertently approve an issue that will fail. But we need to move past that, because Lola has been working in Malaysia for a long time. And as I say, this is an open book exam. You can check what the next guy by you is doing in answering his questions in the examination. Check how Malaysia succeeded. Malaysia just joined FC4S. I needed to mention this. You'll see my background is FC4S. My pin is FMDQ. You introduced me as an SVP in FMDQ. So FMDQ is the secretariat for FC4S. And FC4S is a global institution with 35 member countries promoting green, promoting growth in sustainability. So what SC4S Malaysia has done is something that we need to study. How have they been able to get this Lula to work? In 24 hours, you can issue a security. So I think if we have a fast track process for green issuance, some of the problems that the issuers face in Nigeria, which is time to market, will be reduced. Amaka can agree with me and Gregory too that issuers usually face this problem of a long time to market, and that is why, for example, if you ask me, some people just prefer to go to a bank to borrow straight up and move on. Because by the time you finish the process of issuing, the macros have changed in some cases. The second key point is, which is something that the players in the market might not find too easy, is to develop if you like, a discounted issuance and listing framework because we're trying to build a market from the scratch. Maybe there'll be a time frame. So you could say for the first few years, you could do some discounting so that we're not trying to say that the other vanilla bonds are not important, but we're trying to build a particular instrument here that addresses a very important problem for the entire world. And for Lagos in particular and Nigeria, it's a very critical, it's a critical instrument that must be built. Yeah. That market must be developed. So I think those 2 points, if we look at fast track process for approving green bonds issuance and also discounted issuing and listing framework for these instruments, those are 2 key policies from our perspective, I think can help to develop that market.
Mobilize the market, yeah, absolutely. Yes. Absolutely. And, we worked in the Nigeria Green Bond Market Development Program, so the Nigerian Green Bond Program, basically, as FSD Africa and FMDQ, together with the Climate Bonds Initiative, in order to basically encourage the development and the growth of green bond issuance in Nigeria. So as you mentioned, the program was there to basically support the development of long-term capital, right? The opportunity for long-term capital, because at the time we had availability of short-term capital in terms of bank loans, and as you mentioned, that's probably the most preferred source of capital in Nigeria. And what we try to do basically is to present investors with long-term capital that they could invest in, right? So what are the best lessons learned, or the lessons learned that we had from the Nigerian Green Bond, the development of the Nigerian Green Bond Program, and what can we tell policymakers and market players about our experience with the program?
Thank you very much, Matteo. I think this is a very useful and important question, especially for the fact that you're currently involved in the Nigerian Green Bond Market Development Program as a key actor. Yes, and the fundamental reason that program was set up as a partnership between FSD Africa, Climate Bonds Initiative, and FMDQ was to develop the ecosystem for green in Nigeria. Before we started, I dare say there was no corporate green bond, yeah. We worked with Access from the beginning to become the first green corporate issuer in Nigeria and Africa. And we only had the sovereign. They had issued in 2017 about 11 billion naira, and that program set out to encourage, issuances both from a sovereign perspective and from a corporate perspective. And more recently, you must have seen the news where FMDQ signed an agreement with a subnational government. That will be the first subnational green instrument in West Africa, maybe in Africa.
Yes, the Lagos government, isn't it?
Yes, Lagos state government. Yeah, so one of the things we've learned in the process is that there's a wide knowledge gap. We've had to literally canvass and proselytize, campaign, if you like. We've had to campaign. We've had to speak to banks, to institutions on a one-on-one basis, in webinars, in training sessions, in person, online. We've had to do a lot of engagement and preaching, if you like, convincing people. In fact, the Green Tagging project we concluded was meant to see how we could mainstream, bank loans to become part of the whole capital market equation. We spent a ton of money in, launching that program and engaging the banks for upwards of 1 year. in terms of the time lag, to understand the issues they face, to educate them. So the key point is that there's a wide, gap in terms of knowledge and awareness. Two, as I mentioned earlier, there's a denial of the risk that these banks face. Because if you ask me, I want to be candid here, 35% of the assets of Nigerian banks are exposed to oil and gas, to fossil fuel, because the Nigerian economy is actually skewed towards fossil fuel. So you can even that's a given, and there's a need to make that shift. Not today, yesterday, for two key points. Stranded assets concept. Oil and gas will soon become, quote unquote, a stranded asset. And that is the resource that brings up to 75% or more of government revenues. That is what constitutes 35% of banks' loan books. So we need to increase that awareness and then get banks to begin to finance non-oil and gas related, investments that could help to develop the economy and help to diversify the economy. Apart from knowledge gap and the denial of the risk that we found, we also found that there's a misconception, as I might have mentioned earlier, that we don't contribute a large chunk of greenhouse gas emissions. So why are we being taxed to generate the sort of revenue or resources that we need to tackle climate change? That misconception has to be cured. The third point that we learned is that there is lack of verifiers, local verifiers, and verification cost is a discouraging factor for would-be issuers, which is the reason why, if you recall, we were so happy to launch the first local verifier in Nigeria, and also to support an existing rating agency to register with CBI to become one of the local verifier, so that we can mitigate the impact of having to pay higher costs in USD for verification of issuances. And another learning point is that there's this issue of a lack of a pipeline. So, and Amaka touched on it. So if we keep on saying there's a lack of a pipeline, who is taking that responsibility for building that pipeline, for building that ecosystem? That is where FC4S comes in. FC4S and our partners at the NCIC, Nigerian Climate Innovation Center, we are working to build that ecosystem, to build that pipeline of bankable projects. I used to say this in a lighter mood. If you closed your eyes and went back 10 years, you'll be hearing the problem of lack of bankable projects, and if you close your eyes and went forward 10 years, you still be hearing that. So who takes the responsibility of making projects bankable? So there's need for further collaboration within the actors in the system, expert originators, deal originators like Amaka's bank, experienced issuers like Dr. Greg's bank, the FMDQ, the regulators. We need to look at that. How can we build that ecosystem of bankable projects? So there's a pipeline, and the deal flow for green is regular, it's consistent, and it's enriched. So we found out that there's a lack of pipeline, and we're working on building a pipeline. We also found out that in terms of the regulatory space, there's a need to expand the existing guidelines on green to include social, because currently what we have is a green bonds guideline. I don't think it covers social. I don't think it covers sustainability linked or sustainable bonds. We need to expand that. We need to, if you expand that, Amaka's formula is very, very kosher. It's very sound. You can begin to build starting from social, because the social problems in Nigeria, they are right in our faces. Hunger, poverty, affordable housing. If you begin to build from that, then you can begin to scale up to green, begin to expand the green space. So we need to expand our view to include the social, sustainability linked, and sustainable instrument, and expand the available guidelines and regulations to include that. Those would be my key points on the experiences we've learned and how we can move further.
Very clear, Emmanuel. So I think, to summarize, in line with what Amaka mentioned earlier on, we need to build the market, capacity building, making sure that there's a pipeline of bankable projects. And most importantly, I think that the message is really coming out from you and from Amaka, and then probably we hear from Gregory now, is really synergies in the market. How can actually make sure that we all collaborate together to create that kind of ecosystem, to create that pipeline of bankable projects, isn't it? And so, Dr. Gregory, really your experience as an issuer here comes in very handy, because really Access Bank issued, as Emmanuel mentioned, the very first corporate bond in Nigeria in March 2019. And ever since, basically, the bank has been at the forefront of green finance in Nigeria and really in Africa. How did you overcome all the market challenges that we've discussed now in order to provide that green bond issuance?
Thank you, Matteo. Good morning, good afternoon, everyone, wherever you're listening from. It's my pleasure to be on this call today. These are very apt questions, and I'm very pleased that Amaka and Emmanuel went before me, so it made my job much easier. But several of the issues raised, I was going to raise, they've touched on them in a tangential way. Basically, the challenge that we faced is a pioneer's challenge. I mean, that was the first one. No one had done it before. And to be frank, I was very shocked at the lack of support there was. I mean, you would think that with internet and everything, there should be a wealth of knowledge, online, but you'll be amazed. You can search and search and search. You will not find something that tells you, if you've not done it before, that this is the step-by-step for how to issue a green bond. You will be told a few things. This is user process, this is this, a framework, but the actual organizational gear up to deliver a green bond is a different kettle of fish, and it requires drivers, it requires champions, and that's what I found out. And that's why when people speak about paying lip service, it is because of the challenges. And without those champions and drivers, you probably don't get much progress. So a pioneer's challenge, both even within the bank, it's a green bond. What is this? You have to educate people. So from coming to the market in 2019, that work started probably a good 2 years before, getting the knowledge, getting the setup, getting the frameworks, getting the approvals, getting everything, lining up all the docs, so to speak. Now, the reason why it took so long, because it was new. Two communities are involved, primarily those who will fund the green bond investors, and of course, the borrowers, because at the end of the day, bank is going to raise funds. It's not because we like to be looking at it in our vaults, because we have to go to lend the funds. So that's the pipeline, like Emmanuel said very strongly. So investors were curious. Okay, so what is this green bond all about? We had to speak to them one-to-one in various sessions, just to give them that idea that is doable. It's not only because they had done the Nigerian sovereign, they can relate to a Nigerian sovereign. They didn't really focus on the green aspect of that sovereign issue. They just, well, it's sovereign, so we are fine from a risk perspective, let's go for it. So it was when they now heard about this one, said, well, this is a corporate one, hold on, what are we doing here? Do we really understand a green bond? Why should we do this? So we had to really bring them up to speed. All the issues raised by Amaka and Emmanuel earlier about, we are perceived as a low emission region, Africa as a whole. Why really should we prioritize in this? Let the big global players and polluters, solve these big problems. But we're in the real world, nobody fixes any other country's problems. So we are impacted very strongly based on what happened in the past, as well as what is still happening today. So we need to actually be on our toes to fix the problems from now. So investors, two communities, the foreign investors and the Nigeria-based investors, we knew that there was a big pool of pension funds, big pool of insurance funds, just waiting to be tapped for this kind of opportunity. They had never done it before, and they had exactly the same complaints. So we spoke to them at length, like I said, various sessions. If we don't act now, it's going to get worse, because those investable funds channeled properly to the right outlets, we're going to make a difference, both to our market and to the continent. To cut a long story short, they were persuaded. Of course, at the time, we were looking at both the foreign investors as well as the domestic. Now, by the time we finished all the analysis, from a practical point of view and from a developmental point of view, we leaned towards the local investor market for the obvious reason that if we're going to build cloud, we're going to build sustainability, we're going to build critical mass, the earlier we begin to channel our own funds domestically into these investable outlets that are green, the better and more sustainable it is going to be. The foreign investors, of course, they have to manage currency risk, they have to manage a whole range of things. By the time they factor in emerging market risk and everything, pricing makes it, the pricing goes out of the roof, becomes slightly unattractive. You still have to work with them because they bring a whole range of skills and experience to the table. So we wanted to do that blend of both the foreign and the domestic investor play. At the end of the day, we had more than enough domestic interest. So we went with that and averted the currency management dimension of that. So these were some of the challenges that we faced at that time. And a few other things that we wanted to know was, what are you going to do with the proceeds? How do we know you're going to spend it on, what you say you're going to do? Obviously, they are not exposed to all of those processes. We have to tell them that we might be issuing, but we don't have there is an independent verification process, for example, that you have to follow. We had to use a verifier, a globally known one. We worked with them, made sure that we ticked all the global standard requirements. We didn't want anything that was cutting any corners anywhere. We worked with, we had to be rated. Again, global rating agencies rated the issue itself. Of course, we also had to demonstrate that it was going to be a properly standard climate certified bond, working with the CBI. So again, all of this gave them assurance that indeed, this is a standard issue and there's going to be a lot of independence brought to monitoring the use of proceeds. And it's good that Emmanuel had mentioned with respect to verifiers and the lack of them. So at that time, there was none that was local. So much as we needed local verifiers to be on the table, we didn't have any. But right now there is. So any newcomers to the market now will get the benefit of the new players. Now, the other thing that we had to deal with was with respect to the borrowers. Now, the borrowers is really what makes this thing work. It's all well and good for Access Bank to issue a green bond. We are not going to move the needle significantly if you do not have a market that buys into green borrowing. So the manufacturer, the farmers, they have to infrastructure development, they have to come with a green mindset at the point of thinking through their projects. Now, it doesn't come naturally to them because it's new to them. So your average factory runner is not thinking green. So it has become our responsibility to understand their production processes. So, okay, you know what? You are using production process A. Here is the technology here. Here is what is doing to the environment through its emissions. We are aware of technology process B that is certified internationally, far less emissions. If it is solar, even better. So we have to bring that to the table to enable and see, actually, there is a benefit here. The final question that they ask is, okay, what about my costs? All these things you're talking about is all well and good, but I have to sell products. What is this going to mean for my production? Who's going to pay for this new technology? If it is more expensive than the old technology that I was using, that was polluting, I understand that, but who's going to pay for it? My own customers, they will tell us, are not thinking about green. So why should I carry the burden of the man on the street who is not worried about green? So it's a whole chain of people who have to key into it in order for it to work. So it makes it really heavy lifting. Fortunately, the customers we spoke with at the time, they understood, not completely, but at least we're able to build a business case that let them see that indeed it can work for them, if not in the short term, then in the medium term. And once we had that, it meant we had the investor community on our side, and we also had some key corporate borrowers on our side. So we're good to go. So on that confidence, we're then getting everything ready to come to the market. But it's heavy lifting, like I said, and that work continues today. Of course, I mustn't fail to mention the role that FMDQ played, FSD Africa, various partners, DFIs, all very key, all were rooting for us to do it. In fact, right after we went to the market, we had calls from everywhere in the world. So very well done. We knew when you started the journey, great to see it, through the finishing line. And the benefits are really huge. So sensitization. I think that's really the way to overcome the market challenges. And it's both internal within the organization, if you're an issuer, and external in both the funding community and the borrowing community.
And Dr. Gregory, I mean, I think we heard Amaka earlier on saying that there's a challenge, also Manuel mentioned, there's a challenge of pipeline of bankable projects. So how, as an issuer, you know, what are the challenges of actually, as a loan portfolio manager, what were the challenges of converting those underlying loans into a green bond, given the lack of bankable projects or, you know, project and assets in general?
Yeah, so that's where the tire hits the road, as they say, because that's the crunch. You know, you can do a very glamorous green bond, but you're not going to do very much on the ground if you don't have that pipeline. Like I keep saying, you know, for a big bank like ourselves and other big players in the market, it's a big opportunity to begin to work on that loan book and get it to be greener and greener over time. Right now, it's a drop in the ocean, the proportion of most banks' loan books that are green. And the reason for that is loans were booked, there were legacy considerations. Green was not one of them. Environment and climate were not the issues at that time. So now you have to retrofit, which was precisely what we had to do as well. So you have a pipeline of potential pipeline, as we called it at the time. We got in our partners, we reviewed, because we don't want to do it by ourselves. So we're working on it. We had a position. Then we brought in independent consultants and partners, even DFIs. We come through the book together and say, you know what? The pipeline here is potentially X amount in dollars. It's huge when they said it. I said, wow, you know, we can do, you know, bond of this kind of market. They say yes. However, you then have to go back and work through the documentation. Be sure that you have baselines that were established, that you can establish going back in time from today, whether you have a look back period that is still within the range that you're working with. Go back to retrofit. Now that retrofitting means that you've already signed a contract with the borrower, they're borrowing X amount at X%, etc. You're going back to them literally to renegotiate the loan contract. However, you have not put in there some clauses to make sure that it ticks the box from a verifiability point of view and a certifiability point of view. So a bit of hard work even for those corporates, and that's why we got it, like I said, we worked on them very early on, and they knew what they had to do in the process. So they were reluctant, like I said, it wasn't as if they jumped into it happily at the beginning. When they saw the amount of, you mean, why do we have to do this? You know, you've given us the money already. Are you going to reduce the interest rates now? Are you going to do this? It's a lot of administrative work that they didn't have before. So suddenly they're bogged down with paperwork with Access Bank. I said, no, it's going to be for your own good. And by the time we're through with this, you will see subsequent transactions will be a lot better. Here's the business case. Your own cost over time is going to be better. I'm pleased to say that a couple of those entities, they are now considering their own kind of instruments as they are playing in the green space. I say, well, actually, it's an area where we can actually play. We can issue our own green bonds. Even the ones that did not participate in the processes, when we sensitize them about it, they're not even considering their own process for it because they are beginning to understand what's required here. So to move the needle, to cut a long story short, you need to retrofit, because what we have today on banks' loan books is a tremendous amount of money, well over, the last time I checked, 20-something trillion loan book in Nigeria alone, not talk of across the continent. The bulk of that is, of course, not green in terms of meeting the certifiability requirements. So for it to be green, banks have to now, if you want to play as an issuer, begin to not deliberately identify the low-hanging fruits and key into them to convert them into your green book. The other thing I would say here is there's a lot of internal work required to be able to get things right. Your frameworks, your internal stakeholders have to be right, your treasurers, your financial controller, all of those have to be in place for that conversion process to happen.
The processes that need to be set up and the framework that Amaka was mentioning earlier on, basically. Dr. Jeremy, I mean, Gregory, we have 5 minutes left, and I wanted to ask you the last question, and I would like also to turn this question to the other two panelists. You know, I mean, we talked about Nigeria a lot, but most of the continent is not really as developed, the capital markets, green capital markets are not as developed in other parts of Africa. And at the same time, really climate change is an issue that involves us all. We have to create synergies. We have to work together to make it work, to solve the problem. What even governments and banks and issuers and underwriters across the continent all have to work together. But for your perspective, in a minute, because I would like to ask the other panelists as well, what do we need? What needs to be done to bring everyone up to speed in terms of climate change, in terms of green capital markets in Africa? What do we need to do in 1 minute?
Oh, that's a tall order, but I'll try. Basically, leadership and championing that's it. If you have leaders that buy in and are championing it, then everything else falls into place. I think that's the only way I can summarize it. It requires passion, it requires those dedicated people that can push it, whether it's policy changes, whether it's institutional changes, issuers, etc., coming to the table. So the question is, how do we create those champions? How do we get them, to be thinking like champions, to be thinking that this is possible? So all of that can only come through education, through a forum like this, creating a crop of young executives that we can begin to grow. So through FSD Africa, through FMDQ, through Federal Ministry of Environment, through Central Bank, let's begin to identify those champions and build them. We have locally a certain body of champions. It's not quite fulfilling that requirement yet. So for me, if we deal with that, come up with things to create that body of champions, we are going to clear all the hurdles and deliver on the green frameworks.
So leadership and champion, that's clear. Emmanuel, what do you think? What do we need to do to bring everybody up to speed in green capital markets and climate change in general in the continent in a minute?
Thank you, Matthew, and thank you, Dr. Greg, for highlighting the issue of leadership and championing. I think from my point of view, the major thing we need to do is to have what I call cross-border collaborations. That was mentioned in the Climate Bonds Initiative conference on September 8th.
Yeah.
The African countries that were in attendance included Morocco, Kenya, Nigeria, and co. And there was talk about collaboration between these African countries. At the FC4S level, we have 6 countries that are members of FC4S in Africa. We have Kenya, we have Nigeria, we have Rwanda, we have Cote d'Ivoire, we have Morocco, we have Egypt. All of these countries, and then Senegal is in the works. All of these countries need to collaborate together. For example, in the COP26 coming up, we can have a sidebar where the leaders of this country, and I say leaders, I mean the country's leaders, the central bankers, the central bank governors, the heads of their ministries of environment or departments of climate change can have a sidebar where they meet on how they can set up key policies, 2, 3, 4, 5 things that can be done to expand both the awareness, knowledge creation, and to create an environment that we, be fertile for green issuances, to create access to funding so that there's more inflow of foreign capital into the green capital markets in Africa, and to encourage the domestic lenders to, as Greg has mentioned, take the steps to begin to green their loan book, not because they just want to do it for the sake of doing it, but because they understand the risk. For example, in the case of Nigeria, there's abject hunger, poverty, and security risk that are connected to climate change. There's a whole security situation we're facing with the header crisis and the farmer crisis in Nigeria is because of the impact of climate change on Lake Chad. The fact that particular resource has become has dried up, and so people are having to migrate down south, and that is causing a lot of problems. If you realize that this is a physical problem and imminent danger you face, you take that leadership, that a view that Dr. Greg has spoken about as a country leader, and you drive that across Africa because it affects everybody within the ecosystem. So I will say collaboration between the African cross-border collaboration, is key.
Perfect.
Yeah,
great. Thank you, Emmanuel. And Amaka, your view on this? What do we need to bring everybody up to speed to climate change and the green economy in Africa?
I think the only thing I would add to what my fellow panelists have said is reiterating what I said at the start, which is embedding sustainability objectives as a strategic priority of countries and companies within the country. And again, we tend to see that at the end of the day, if a company wants to go, if the end borrowers want to borrow money from different financial institutions or different investors and find out that they're all thinking from the same song sheet, your business needs to be more sustainable, they would have no choice than to do what it takes to make their businesses sustainable. So it needs to become part of the DNA of the entire ecosystem for us to be able to deliver.
Thank you very much, Amaka. And on behalf of FSC Africa, I would like to thank our panelists for being us today, Amaka, Emmanuel, and Dr. Gregory. Thank you very much. Have a good day and good Sunday. Thank you.
Thank you, Matthew. Thank you, fellow
everyone.
panelists. Thank you, everyone. Thank you.
Thank you all. Bye-bye.
Have a good day.
Yeah.